Gold has enjoyed a very good run over the last few years. We were expecting it to almost hit $2,000 an ounce. It nearly got there, but since it hit around $19, $20 an ounce, it's come back really. But the key driver in gold over the last few years since the financial crisis has been this protection against inflation. Now, with central banks supporting economies around the world with quantitative easing, and which is essentially viewed as printing money, investors have looked around for physical assets that retain their store of value even in times of inflation, and they've naturally seen gold as a useful source of this protection. It's been running higher for quite some time. In fact, it was one of the most sustained trends in gold for quite some time. Now, a lot of people have been buying gold for a long time, but it's only the last 10 years and its popularity has really taken off. And this is because it's become easier to trade both through IG and also through ETFs and other forms of trading, that you can more easily access gold than you could in the past. When IG was founded back in the 70s, the IG stood for Investors Gold. That was when it was very hard to actually trade the price of gold. You didn't have the sort of online trading platforms and the easiness of trading gold that you do now. And it was set up as a means for a number of people based in the city who can actually trade on the price of gold, because this was when the price of gold itself was fixed twice a day, and it would actually be a physical meeting of people who would fix the price of gold, and then the price would be dispatched around the city. And clearly in this globalized market it doesn't work like that anymore, thankfully. Gold is an ever traded commodity, a very high volume market. There's speculation in terms of how they think central banks and governments will play out in terms of inflation policy. A lot of people have expected that QE to continue in the US and Japan and Europe for an extended period, and indeed the 5th year since the crisis we are still in an environment where central banks are propping up the market with quantitative easing. So that's been the key driver, and when you have a central bank announces a policy decision, if they look to be expanding their QE program, often gold can be pushed higher as a result. If conversely they say that they might think about reducing some of the QE program in the near future, then you'll see the price of gold edge back, because people move out of physical assets, or what they perceive as physical assets, into actual paper currencies. So it's very much a play on how you view the global economy in terms of central bank support, and whether governments will look to boost their economies through unconventional policy. There has been a lot of that. Gold has taken on a life of its own, really. Obviously, in the darker fringes of the internet, you'll find plenty of people who are extolling its virtues, regardless of what happens in the actual global economy. I think the key is not to look at it in that sense. Too many people get seduced by just constantly buying the price of gold, whatever happens. And like any other market, it goes up and down. And we've seen the sharp moves in 2013 with a fairly sustained downtrend in gold suggests that for now, I think the long bull run has run its course. That doesn't mean we won't see gold perhaps rise ever again. It just means that for now, a lot of the speculative money has gone out of the market, and we are perhaps left with the hardcore adherents of gold who will still buy it regardless of the current direction of the price. Because they're all priced in dollars, you will see a lot of moves in tandem for those commodities. A weaker US dollar, if that drops down in the day due to, say, expectations of more easing from the Fed, then you'll often see commodities move upwards together. Conversely, if you get worried about the US economy, you tend to see what's called safe haven buying. So people buy the US dollar and US treasuries, because regardless of what happens in the global economy, you'll still get some degree of return in US treasuries. So they move out towards the dollar and away from gold, and it makes these commodities more expensive when the dollar goes up. So clearly, if something becomes more expensive, the demand for it tends to drop away. So it's very much demand and supply in terms of US dollars for these commodities. So that's why you do often see gold, silver and oil moving in tandem and moving conversely to the price of the US dollar. I don't think they perhaps grasp it when they first start out. It's probably a lesson they probably understand the relationship quite quickly. It becomes relatively apparent fairly soon after you start trading. Of course, with IG, you're not trading in dollars per point, you're trading in pounds per point. So that exchange risk is removed. You don't have to worry about pricing your gold first in pounds and then into dollars. It's worth bearing that in mind. But yes, I think it's not obviously apparent to a new investor that gold and the dollar have this close relationship in terms of how the US economy is viewed. But any time spent researching a market, as you should do with any market, you should clearly look at what's moving that market and what factors affect it. And research will show that the closeness to the US dollar and gold is something that you should always keep an eye on. We saw a lot of selling of gold in the 1990s, most influentially by the Bank of England in the late 1990s. And then, of course, the gold price rallied sharply, and a lot of investors took the opportunity to use the benefit of hindsight to say the central bank shouldn't have sold gold. But the interesting trend now is that you're seeing a return to buying by central banks, not in the US and developed economies like Europe, but in emerging markets. So Russia, China, India, East Asia are seeing a sustained buying of gold, and especially now that the price has dropped back slightly, you're seeing other central banks boosting their holdings of gold, partially because it's a hedge against the US dollar. And the US central bank's actions have pushed the dollar down, so that devalues their own currency holdings. So by moving into gold, they provide some sort of hedge against that movement. So you have seen a shift towards buying in central banks for emerging markets. Conversely, with the Eurozone crisis still rumbling on, there are repeated calls for some of the central banks in the affected countries to sell some of their gold holdings to boost their financial position. We saw this most recently in the Cyprus bailout, where there's a continuing will they won't they over whether Cyprus will actually sell some or all of its gold holdings. But we know Germany, the Bundesbank, is one of the largest holders of gold in the world. There was some crisis or some talk recently when it insisted on transferring some of its gold holdings back from the US and the UK towards Germany, and what that might mean. Of course, it's very difficult to tell in the Eurozone crisis what that would mean in the long term, but it has kept gold in the news.